So in terms of investment mandate limits and currency controls, exchange controls, it's not about limiting investment opportunities in foreign countries outside of Africa, but it's more about developing the infrastructure and opportunities in Africa at the moment and between cross borders in regions in Africa. So mainly that's done through the private equity space at this stage because of liquidity issues on the listed side. There's also there's more opportunities, I suppose, at this stage in the private equity space. I've mentioned we've got about 30% effectively that South African investors can invest in Africa, but there's no room for that 35% or 30% at this stage, not even at the 5% limit. So private equity is definitely the current vehicle for investments. And given private equity as an asset class, it's starting to develop as a proper asset class now with a lot of years of involvement in deal structure, I suppose, and there's a lot of positive stories coming out from the likes of global consulting groups such as Boston Consulting, McKinsey, Goldman's. That needs to be backed up by credible investor returns and deal structures, deals and successes in terms of deals made. And that will, as soon as that comes through from a credible source, capital will flow and perceptions will be broken down.
Africa is an economy, a continent on the move. There is just so much change and development going on at the moment. And it's coming from many different angles. You hear about the resource boom, so to speak. You hear about people from Asia coming in, people from all over the world looking to extract these resources. Infrastructure, there's a huge amount of development of infrastructure going on. There is a growing demographic change happening. Africa in 10, 15 years' time will have probably the largest workforce on the planet. The age demographics. There is growing incomes, growing middle class, brand consciousness, awareness, fast-moving consumer goods. You've heard of Africa as being the potential breadbasket of the world. And we're seeing a lot of change, actually, and if I come back to East Africa, in the last few years, last couple of years, we've seen a dramatic shift. We've had oil being discovered, oil and gas, off of the coast of Tanzania, in Uganda, Southern Sudan, DRC. The resource has also been found in Kenya recently. An enormous transformation is about to happen in East Africa, and we're seeing it all the time. Just the number of trucks on the Nairobi-Mombasa road. Somebody told me recently that on any given day, there are about 6,000 trucks going up and down that road, which is not that way a few years ago. The railways are being sorted out, the infrastructure is being sorted out. The number of foreign investors, well, what do I say foreign? The number of private equity firms operating in East Africa is gone up astronomically. I think we've got probably 30 on the ground with offices in the region, and then another 25, 30 that fly in, fly out. So it's enormous changes are happening. Yeah, I mean, I think what we see in the news is often very negative, and I would urge people to actually take a trip to Africa, come out and see for yourself that the opportunity is, I believe, real, and it's coming from a low base, and people everywhere have the same drivers. You need the basic needs, you need to take care of your families, you need X, Y, Z, and it's the same everywhere. And Africans are no different. And education is helping, healthcare is helping, and access to this. And so the opportunities, pretty much in any field, it doesn't really matter, across the board, you're there.
Pension funds have been successful and they have looked after their members' needs. The pension funds really divided into those which are public sector, like the Kenyan Social Security Fund, like SNIT in Ghana, and then there are the private ones, which are the pension funds of major companies. And these look after their members' needs very well. Besides that, you have the teachers' funds in the various countries, the public sector worker funds, which are run independently of the government by independent trustees. And I think it is the word independent which is the key one. So Kenya has most probably a pension fund industry which is 20, 30 billion, 40 billion dollars. Nigeria's, which started later, but with a much bigger population, is growing very rapidly. And so they're most probably at 50 billion. Now, compared with the South African ones, they are small, but then the South African one has been running for decades and with accumulated contributions. And it's the accumulation of the contributions which count. Where are they investing? Public sector, treasury bills, and treasury bonds is their largest allocation, followed by equity investments, primarily listed, and then thirdly, real estate. They've evolved very positively. The debt markets, for instance, 10, 15 years ago were short-term, 2-year, 3-year maturity. Now they are out to 20 years. Kenya, Nigeria, Mauritius, they are successful, and Zambia. Zimbabwe used to have a very, very good pension fund industry, but the period of hyperinflation in the Zimbabwean dollar effectively reduced it to zero, and they've started off again, this time with the US dollar as their functional currency. But overall is West Africa, East Africa, and down to South Central Africa, very successful. And of course, South Africa is one of the, should we say, the leaders in it, because there's the intellectual thinking there, the asset diversification, and the risk management. And that's a key thing. So one of the characteristics of the domestic pension fund industry is they are national, they're not international. They are becoming regional, and you find that in the case of the Kenyan pension funds. The Nigerian one is primarily domestic, but then the domestic market is big enough. The stock market has a market capitalization of 50 billion. But what you also see is within the various countries is, and this was the case, has been the case in South Africa, is the asset allocation to equities is X%. Same in Nigeria, it was a maximum of 25%. In Kenya, I believe it's around about 30-35%. So one of the reasons for this is the inherent conservatism of the funds. The regulators don't want cowboys in charge of people's retirement funds. Therefore, they're linked to it. So what's the biggest one? If you've got positive real rates of interest, that means if you are limited to treasury bills, but interest rates are positive in real terms, pension funds are winning. And they are growing in real value on an inflation-adjusted basis. That's the key point these regulators have been looking at. What will make them less conservative? I don't think they will change very much. They will change a little, but only at the margins. Far more important for them is to have low inflation, lower interest rates, a well-run government, which then enables them to extend their time horizon and take longer-term risks, should we say, from the treasury bond market into equities and real estate. Because if you've got a piece of real estate, you want to get it running for 20 years, not for 5 years, because your yields are relatively low. But one area for a pension fund or the pension fund industry, which I could see as where they could be innovative, is bring about listed real estate companies. People in Africa like real estate, but there are no outside of Botswana and South Central Africa, there are very few listed real estate companies. So Kenya doesn't have one. That means every piece of real estate is on someone's balance sheet, and they haven't been brought into a diversified portfolio of commercial property. So bank pension funds own the branch networks or the head office, and then they get a rental from the bank. Well, there's nothing wrong with that, but there are other people who'd like to share in it. And if you can get it above trading above book value, then the person owning the asset is making is gaining, and a well-run property management. But there is plenty of opportunity for real estate investment in Africa, and the real other point is that real estate is an illiquid investment, but it's a necessary one. So I think there's tremendous opportunity there, of where you take an illiquid investment off a firm's balance sheet and put it into a listed real estate company. So I think tremendous opportunities. And historically Treasury bill returns have been positive when interest rates have been positive in real terms, which has generally been the case. And secondly, with a growing economy, the listed companies are growing in value. So you see this across the banking sector, across the manufacturing sector, and across the services sector.
Well, I'm going to respond to the question about governance and transparency issues from South African perspective. I boast of the fact that we're a very well-regulated industry. We've got world-class systems and procedures in place. However, there's a school of thought, Bafu, that says that maybe we're focusing too much on governance issues and neglecting the real spirit of retirement funding, which is maximizing returns and so forth. So I think in a sense that might just answer the question that yes, we certainly have robust policies in place, and maybe we're focusing too much on those, which isn't a bad thing, but we need to balance it with the needs of the country and certainly the contributing members. Challenges and opportunities. I think challenges always offer opportunities. Again, from a South African retirement fund industry perspective, and certainly as South Africa as a whole, the big challenge is to create a mindset change, to inculcate a mindset that the masses in South Africa start saving. We're a country that do not save as we should. So that's the one thing. And with that comes a lot of opportunities. The other thing is South Africa is busy working on its reform proposal to have a social security plan in place that will assist in getting people to save. And I mean, obviously, so that there's no burden on the state when people become old. So that's a big challenge. Again, that poses a lot of opportunities. And yeah, that's what we are working very hard at. And working very hard in a South African context is lots of consultation, lots of debates, and I'm very excited, very excited.
As momentum asset management, some of the trends we're seeing across sub-Saharan Africa are all to do with the rise in consumption of the consumer. A lot more people have got spending power. They're earning money formally or informally, but they're now starting to spend a lot more of it on branded goods and services that they actually need to enhance their lives. So we see the opportunity as twofold. First of all, to participate in businesses that are offering the goods and services that they need, but as an investment management business ourselves, to offer them some of those services that they would actually need. The advice I'd give to any investor who is not on the continent, who's thinking about spending money on the continent, is go and see it for yourself. What is taking place on the continent is amazing. The perception gap that exists is huge. A lot of people do not fully understand what is actually taking place and the gravity with which and the scale on which it is actually taking place. So go and see it for yourself, but also partner with somebody who has a presence on the ground, somebody who spends a lot of time in country, understanding the businesses, understanding the opportunities, and digging out those opportunities. And lastly, be patient. This will take some time.
It's been very interesting. I think one of the things that has struck me is how we rarely hear anything dramatically new about the investment opportunity in Africa. It's a fairly familiar story now. But what is new and what has been interesting about the last couple of days is the degree of interest from different kinds of investors. So we've had a number of private equity investors talking about the opportunities that they see across a wide range of different sectors and countries. Potential investors talking about how they like that theme. Our particular interest in Inparo is in the listed security space. So we invest in equities and in fixed income, both in hard currency and local currency. So we're like many other people here, we're already persuaded of the value of investing in Africa, but it's interesting to see people approaching it in so many different ways. The major opportunity is just the opportunity on the ground. The fast growth rates, 5.5% to 6% growth rates in Africa. The opportunity to invest now is much more alive than it would have been 10 or 15 years ago because of improvements in the institutional framework. The challenges, I would say, are not so much to do with Africa. People are familiar with the concept of political risk. If anything, political risk is priced in places like Africa, whereas it hasn't been in, for example, Greece or Portugal. So that's not so much of a hurdle. The challenge is simply that since 2008, would-be investors are very wary about investing in anything new. And by definition, an African fund is relatively new. So it's not so much the concept or the theme that they're nervous around. It's just it takes them a long time from first meeting an investment company to deciding that these are people we want to work with and it's a strategy that we're going to commit to. So we've done a lot of meetings over the last 18 months, for example, and we wouldn't be at all surprised if it takes another 18 months before they come to fruition. So as managers, we have to be patient and we have to keep turning out good results, keep spreading the good news about the opportunities on the ground, and I think it'll pay off in the end.
What we see as a fixed income investor, what we see when we engage with potential investors is that there's an education process that's required. And it never fails to surprise investors when we show them charts of what the fundamentals look like of sovereign African balance sheets relative to the developed world as well as relative to emerging markets. We see an increase in interest and a growing sense that some of the risks have been misperceived when we, again, show them the data around some of the governance indicators and where African countries stack up against more traditional emerging markets. So what we would expect to see over the coming few years would be an increase in allocations to Africa, because we typically try to position our fund as an emerging market debt add-on fund, so frontier market debt, but we are 55% exposed to Africa and then the rest to the Middle East and frontier Asia. We are a liquid vehicle, which provides a lot of comfort and that exact reaction from investors when we tell them that we can provide weekly liquidity. So what we do is look for securities that provide us with the requisite liquidity to be able to manage that. As such, there are countries that we cannot enter because they don't provide us the requisite liquidity. So we do investigate the use of CLNs to give us exposure to individual countries and currencies that we would like as part of the portfolio to remain diversified. Essentially, we see diversification as a very powerful tool and as a very powerful motivator for including Africa. The demographics in terms of population, in terms of increased literacy and basic education and higher education, and combined with rolling FDI trends and combined with falling levels of inflation across the sub-Saharan African region, for instance, and the existence of a longer period of relative peace, peaceful transitions in democracies, or peaceful democratic transitions, all add up to ways in which hopefully investors are getting more comfort, and we're going to provide them with ways in which they can access the opportunity through a number of relatively plain vanilla instruments.
I think it did take a long time to happen in developed markets. It also took a long time wherever it's happened. But that said, I think it's not a matter of it's Africa or Asia or Latin America. I think each corporate entity in which one's trying to invest, or infrastructure project, or issuance of debt, etc., brings with it its own risks and opportunities. And although those risks are often seen purely in sort of simple financial terms, often it's more complex than that. So environmental factors, governance factors such around bribery and corruption, etc., are known to have an effect on economies. Issues around climate can have an effect on these things. So how well companies manage those issues and how they exploit the opportunities that those issues bring to the fore can create a more profitable enterprise and therefore bring more added value to both the investments one's making, but also arguably to the economies in each of the various African countries.
Fantastic. So when you look at some of these ESG practices when incorporated by these investors, some of them argue that they add a more complex layer than they should, and they make the process of investing, it makes deals take a little longer than they normally would, and maybe they don't have the capacity to actually put that in practice. What would you say to these investors, and in terms of looking at the investment horizon on a long-term basis?
Well, I think the long term is the key to what you've just been asking there, because evidently some of these issues may result in the need to conduct greater research, greater due diligence, etc. But if you're investing for the long term, this is a conference we hear about pension funds, sovereign wealth funds, they're investing for the long term. And a lot of good investors do. And therefore, there's a long investment horizon, and some of the impacts of various environmental and social and other challenges are long term. Some are immediate. We've seen the issues in South Africa around lawmen, etc. Company being around for a long time, having particular challenges in that place. Capacity is a different point. Capacity does take some time to build up, but there are initiatives within Africa. Obviously, there's the Africa CIF itself in South Africa, which has membership across the continent. There's institutes of excellence in different countries. So over time, drawing upon expertise from other countries, but also crucially from within Africa itself, it should be possible to apply these sorts of principles to therefore better protect the long-term value of investors for pension funds and sovereign wealth funds.
It's been very interesting, very informative. Quite a lot of different speakers with different angles who didn't always necessarily agree, but which also gave quite some insights into how to look at the African market, also better understand the differences, because sometimes people see Africa as a quite of homogeneous continent, which it just isn't. There are a lot of different cultures, a lot of different financial markets, different regulations, and different issues that also relate to these specific markets. That's a good question. I think if you look at how investors are currently looking at their investment portfolio and trying to understand the risks and also the opportunities relating to environmental, social, and governance issues, they feel sometimes they're lacking the information to make a properly informed investment decision in Africa, for instance. And there's a certain hesitance for them to also to enter these markets, which might not always be justified. So what we're seeing that actually investors that are looking at the African markets and are trying to make an informed investment decision by looking also at some of the non-financial elements and trying to understand the risk relating to certain markets, but also opportunities these markets can offer related to the changing society, relating to issues like, for instance, water scarcity, looking how well companies are prepared for what's coming up, will actually give them an advantage compared to other investors that are not looking at these issues and are not able to also make them part of their investment decisions.
Well, I thought the conference was very fast-moving. I mean, we had a number of sessions, and they went from, having the sovereign and pension funds on one panel to the private equity on another, to asset managers on another, and banks on another. So I thought it was very rich in the number of participants it had. It was very fast-moving in keeping the format in a panel discussion format. So a lot of dialogue, and maybe one almost needs a minute to absorb all that was discussed. So I'm hoping that some sort of content summary will emerge, because it was a very rich discussion. It was a very important panel for us, and we wanted to make the point that the ADB is Africa's bank. We are here, we are owned by the 54 countries of Africa, and we really look at investment in all countries and really try very hard to bring about economic growth. And my message to the audience here, which included a lot of private sector companies, a lot of people in capital markets based in London, was come talk to us. I mean, understand us, how we work with all the donor capital, etc., and then come talk to us about instruments that might work, that might support their investments, increasing their investments in Africa. So we pretty much see ourselves as the honest broker. We want to see good deals happening. We will, on some instances, advise governments, but we just want to see good infrastructure deals take place, and we'll put our capital behind it, and we want your capital to join that. Well, it's interesting. There's always been a debate as to is there more money or are there more projects, you know? And I mean, maybe one conclusion would be when we're thinking of this $22 billion bond that President Kabruka has announced on infrastructure, which could be based on even that's 5% of central bank reserves. And if we did that, you know, a $22 million bond, we want to see good infrastructure projects. And so we feel it would be very important to have a project preparation facility as part of this. And another report done by the Infrastructure Consortium of Africa has identified more than 60 project preparation facilities on the continent. So I think part of this whole exercise on even fundraising, mobilizing, is also bringing Africa together and creating these synergies that just bring out the best of Africa. So that's our role, and that's what we want to do.